Hi, good morning, class. Hope everybody's doing well today. My name is Andre Uhas, and I will be going over the Royal Mail case. And let's get into it. So, first things first, we're going to be getting into a little bit of background on Royal Mail. So, Royal Mail is the UK's leading postal service. They are responsible for delivering letters and parcels to millions of addresses across the country and as well as internationally. Royal Mail was established all the way back in 1516, is actually still active, and is one of the world's oldest postal organizations. And on the right here, I was able to find a picture that dates back to 1939, which I found was very interesting. So the case explained. Back in 2015, Royal Mail had just made the big move from being a government-run service to being a private company. At that point, analyst Hillary Hart was tasked with figuring out Royal Mail's cost of capital, which is an important financial number that helps measure how much it really cost the company to raise funds. The company was also facing some real challenges at the time. Fewer people were sending letters, parcel delivery companies were stepping up their competition, and regulators like Ofcom were still keeping a close watch on operations. Understanding the cost of capital really mattered for Royal Mail because it influenced a lot from what kind of investments and strategies the company could pursue to how it interacted with regulators. It even had an impact on things like long-term planning, employee confidence, and future probability. So we're going to be talking about the Royal Mail case and how it focuses on the issues that Hillary Hart and the company were facing after the transition from being a public service to a private business. That shift brought a lot of new financial challenges and forced Royal Mail to think differently about how it operates. A key question in the case is how to determine Royal Mail's cost of capital, basically the rate that it influences investment decisions and how investors measure performance. Then there's the Kyle Brooks analysis, which helps us see how Royal Mail's situation stacks up against other companies and whether these comparisons really make sense given Royal Mail's specific circumstances. Finally, the case also pushes us to think about which principles or rules should guide a firm's corporate cost of capital. That helps highlight what Brooks got right and what could be debated, and how those finance ideas actually apply to real world decision making. What happened with Hillary Hart and Royal Mail? Back in 2015, Royal Mail was going through a huge change after becoming a private company. It was moving away from being government ran and trying to operate more like a competitive business in the open market. At the same time, it was dealing with fewer people sending letters, stronger competition in the parcel delivery sector, and tight regulation from Ofcom. In the middle of all that, financial analyst Hillary Hart had the job of figuring out Royal Mail's cost of capital, which was a very important number that would help management decide where to invest, how to value the company, and how to approach future talks with regulators. Next, we're going to be getting into the importance and cost of capital. The cost of capital is the minimum return that a firm must achieve to meet investor expectations, acting as both the benchmark for new projects and the discount rate in valuation models. It represents the opportunity cost of investing in the firm, as investors have the option to invest in other securities with comparable risk. Although managers estimate and utilize the cost of capital, it is ultimately determined by returns required by investors on debt and equity. Management is responsible for accurately measuring the cost of capital and applying it consistently in strategic decision making. We're going to be analyzing the Kyle Brooks analysis. So on the right hand side here, we have the market value that was reran. On the left hand side, we have Kyle Brooks's analysis, he used book values. So there's going to be a couple of differences here. The first one's going to be the equity. In Brooks's case, using book value, it came out to 3,846, and when using market value, it came out to 5,110. Next would be the weighted average, which was another difference. Brooks had 3.188%, and when reran using the market value, it was 3.776%. The next one that stood out was going to be the risk-free rate. Brooks had 1.551%, and when using market value, it came out to 2.03%. So with that, Brooks had a weighted average cost of capital of 3.828%. When reran using the market value, it went up by a little bit, and it came out to 5.137%. Now that we've looked at the charts, we're going to just be interpreting the analysis by Kyle Brooks. Brooks employs the weighted average cost of capital model and outlines his assumptions. However, he weighs debt and equity using the book values instead of market values, which would be better, which it reflects current investors' expectations. His cost of debt is derived from coupon rates of existing bonds, neglecting the yield to maturity, which represents the true market cost, particularly since Royal Mail's bonds are trading above par. For equity, he depends on the dividend yield rather than coupon, which would accurately account more for the growth and risk factors. He compares Royal Mail to utilities, which is not ideal as utilities operate under stable regulations unlike Royal Mail, which faces a more competitive and fluctuating environment. Overall, in summary, Brooks's approach underrepresents Royal Mail's risk and results in a cost of capital that is too low. Incorporating market-based inputs would increase the estimate from 3.828% to approximately 5.137%. Next, we are going to be looking into some comparable firms regarding the weighted average cost of capital. So there are 3 companies that we took a look at comparing Royal Mail. The first one is National Grid with a cost of capital percent of 4.235. Vodafone with a 5.551% cost of capital, and Tesco with a 5.497%. We can automatically eliminate 2 companies, National Grid and Tesco, because these are in different industries. So the closest comparable company to Royal Mail would be Vodafone. They're also in this similar industry with communications. So we can look at Vodafone as the most comparable firm. When calculating the corporate cost of capital, there are several important guidelines to consider. First, use market values instead of book values. The proportions of debt and equity should reflect current market prices instead of historical accounting figures. This provides insight into what investors believe the cost of investing in the firm truly is. Next, add risk to the numbers. The equity risk number and the cost of borrowing must accurately represent the actual risks the company encounters. For Royal Mail, it is essential to differentiate between the stable post-monopoly aspect and the more volatile parcel delivery segment. Next, you want to look forward, not backwards. Elements such as the market risk premium, growth projections, and the risk-free rate should be based on anticipated developments instead of relying solely on historical averages that may not be relevant to today's market. And last would be keeping the timing the same. The risk-free rate, beta, cost of debt, and capital structure figures must all originate from the same time frame. Combining current data with outdated information can distort the outcome. With all that being said, we're just kind of go over everything that was mentioned today. The cost of capital for Royal Mail is significant for both investors and regulators. The weighted average cost of capital is at 5.137, indicating a relatively low hurdle rate for a new project. This level suggests that Royal Mail can finance initiatives at a cost that aligns with market expectations. When compared to competitors like UPS or DHL, the rate is fairly similar, although these companies occasionally report slightly higher figures. The crucial aspect is how this figure influences budgeting, pricing, and shareholder returns in a competitive, regulated market. So there's a couple key takeaways. The initial calculations in Brooks's work underestimated the cost because they relied on the book values, outdated rates, and mixed inputs. The updated figure of 5.137% offers a more dependable benchmark that reflects investors' expectations, and the alignment of the weighted average cost of capital with that of competitors validates the estimate and reinforces its application in strategy and regulation. So that's all that we have for today. Thank you so much for listening and paying attention. I hope you guys have a great day.